We're talking about closed-end funds with Vad Yazvinski, who has been a co-panelist of mine on MSN Money's Strategy Lab. Hello, Vad.
Hey, Howard, how are you?
Good, good. Vad, you've been looking at closed-end funds, and this is kind of a play that is really kind of a seasonal play. A lot of people buy them in December and sell them after January because the spread between the price and the net asset value of the funds generally is very favorable at that time. But you like some now as well, right?
Correct. And what happened, it is correct. Basically, one of the reasons that spread actually occurs, if you read all the scientific studies about it, it's basically that in December, a lot of people selling for tax reasons, and if there was a bad year or they had some, they basically liquidate in December. And because closed-end funds, when compared to open-end funds, they lack liquidity. Mm-hmm. So if somebody's a lot of people are trying to sell them, it will not change as you would buy Spider. You basically buy in a basket of stocks at some point of time at correct prices.
Right.
It trades just like a stock. So the discounts widen as liquidity issues appear.
Fine. So what areas are you looking in for closed-end funds right now?
Actually, if you look through them, the discounts are higher than historical norms are pretty much in any sector. But I prefer closed-end funds that employ a buy right feature.
Now, what does that mean?
That means they buy stocks, they sell covered calls or puts. They sell puts against the portfolio of stocks, mm-hmm. and then pay it out in the form of dividends. So
the premiums on the puts they pay out in the form of dividends. Okay.
And they pay out very healthy dividends, 10-15% on average. With this volatility, the great thing about today's market is with volatility this high, they've been able to generate a lot of income.
Good. So any particular ones that you like?
Yes, I like, if you like their IT sector, there is one called QQQX.
Oh, okay.
And
that's based on the NASDAQ Qs?
Correct. Yeah. The largest holding is Apple, and you basically would be buying Apple at 15% discount, mm-hmm. and get some dividend in the meantime. You also have the international ones I like. There are two. One is IGD, mm-hmm.
Run
by ING, mm-hmm. and then one EXG run by Eaton. Oh, Vance, and then I have several of them playing some plain U.S. sector. BEP will have S&P and DPD Dow 30.
What is the risk involved in these closed-end funds for investors?
The main risk for the investor is that if you buy in something at a 30% discount and you believe the discount will narrow, the main risk is that it doesn't, or it gets wider. So if the liquidity that events that created the entire opportunity back in November, October, when everybody was just selling it, there was nobody buying it, and the yields, the discounts got very wide. They narrowed quite substantially, but I believe that they will narrow it back to historical norms when liquidity comes back, which it seems to be happening right now.
Okay. Thank you very much.
You're welcome.
We've been speaking with Vad Yazvinski on the MoneyShow.com video network.